Coming to chapter number 3, investing in stocks. So there are some risks which are involved. First and foremost, you have the market risk. Then you have the sector specific risk. So market risk typically is overall as a market, what risks you face. Sector specific is to that particular sector. Then you have a company specific risk, which is associated with the management and the maintenance of that company. And then you have the liquidity risk. So these are the 4 broad risks in the equity investments which you face. If you have to review, I have an overview of the equity markets. You have listed versus unlisted. There are listed versus unlisted securities. Investments are relatively more liquid than investments in your unlisted securities. So in listed, it is more liquid as compared to unlisted. Preference shares, if you have to talk about, in addition to equity shares, companies may also issue preference shares, and they rank above the equity shares with respect to payment of dividends. So whenever a company is issuing dividends or paying dividends, the preference shareholders will get a priority above the normal shareholders. And the distribution to the company, and in case of liquidation of the company also, when the assets are distributed among investors, they will get a preference or normal equity shareholders. Preference shares do not generally have voting rights like equity shares unless stated otherwise. So the chief character of equity shares is shareholders' participation in the governance of the company through voting rights. So somebody who is an equity shareholder actually decides and wants to be a part of the governance of that particular entity. But preference shareholders, that is not their concern. Their concern is to invest and to make profits out of the overall investments. Equity research and stock selection, if I have to talk about. So how does fundamental analysis work? Determining the stock's intrinsic value. That is objective. These values depend upon underlying economic factors such as future earnings or cash flows, interest rates, risk variables, etc., etc. Investors should buy the stock if its market price is below the intrinsic value. They will not buy or sell if the market price is above the intrinsic value. So typically when we talk about fundamental analysis, there are 2 approaches. One is a bottom up and other is top down. In top down, you look at essentially the global economy and then the Indian economy. Then you look at the industry specific or the sector specific, and then you look at the company. In bottom up, you identify good companies basis certain parameters. Okay. Once you have identified the company, then you move to the industry level. Once you've identified the industry, then you move to the economy level. Okay, so it is backward. So I identify a good company basically in the bottom up approach, basis certain parameters. Then I will see which industry it belongs, and if the industry is not in my picture, then I may remove it, and then I go to the economy part. Then you have the buy side and the sell side. So on the buy side, you have analysts who work for money managers like mutual funds, hedge funds, pension funds, portfolio managers. On the sell side, you have analysts who work for firms that provide investment banking, broking, advisory services for the clients. Coming to stock analysis, the main objective of stock analysis is to make critical risk return decisions at the market or the industry or the company level stocks. So analysis of an economy and market, that is the first thing which we do. Then the next step is process of examining various sectors. Then we get into analysis of stocks. Then you have the industry life cycles, which are important. So there's startup, there's growth, there's maturity, there's decline. And then there are other things which are intensity of rivalry within an industry. So threat of substitute products, bargaining power of buyers, that is customers, threat of new entrants, and bargaining power of suppliers. When we look at company analysis, what do we determine? Determines the value of the stock. So in company analysis, you have the financial statement analysis, or popularly known as the FACs. Then you have the SWOT analysis, P&L, balance sheets, cash flows, ratios, strength, Okay. So these are part of your FSAs, which is a financial statement analysis, the profit and loss analysis of the P&L statements, the balance sheets, the cash flows, and the ratios. In SWOT, you have the strengths, weakness, opportunities, and threats. So this is what determines the value of the stock. Coming to intrinsic value, you have the so in case of discounted cash flow model, what we look at is streams of future cash flows, timings of these cash flows, and then the expected rate of returns for the investors or the discounted rate. When we look at free cash flow, it is net borrowing minus the interest rate. Coming to valuation, asset-based valuation, basically value of business is your assets minus your liabilities. This is extremely used in businesses which are asset oriented, such as real estate, shipping, aviation, etc. Then you have relative valuation, which is typically identifies companies, comparable firms, and then obtains the market value of equity of these firms. So here implicitly, it is possible to determine the value of the economic entity by comparing it to similar entities based on several important ratios. Then we have certain ratios which will look at PE. Everybody understands this. It is the price to earnings ratios. So it is basically your stock price divided by EPS. You have two options there. One is historical or trailing PE, where it is the stock price divided by the quarter 1 EPS plus the quarter 2 EPS plus the quarter 3 EPS and the quarter 4 EPS. So stock price divided by summation of 4 EPSs, and that is how you get historical or the trailing PE. When you look at the forward PE, it is the EPS, expected EPS for quarter 1, quarter 2, quarter 3, quarter 4. That is in the denominator, and in the numerator you have the stock prices. Coming to PB, or the price to book ratio, this indicates how much the shareholders are paying for the net assets of a company. So PB typically is stock price per share divided by shareholders equity per share. So if you have to look at PB, it is another relative valuation ratio used by investors. It compares the stock prices price per share to the stock's price per share to its book value, that is the shareholders equity. Price by book indicates how much the shareholders are paying for the net assets of the company. Coming to the next ratio, which is the PS. Lower the PS, more attractive the investments. PS ratio is basically market capitalization divided by the sales revenue. So market capitalization is number of outstanding shares multiplied by the price. The last is the price earnings to growth ratio, PEG as we call it. So PEG considers three factors: price, earnings, and earning growth rates. And it may be used to express the extent to which the price that the investor is willing to pay for a company is justified by growth in earnings. PEG ratio helps investors determine the degree of reliability of that growth assumption. So how reliable is that growth assumption is what we come to know. So PEG is actually price divided by price to earnings ratio, that is divided by the EPS growth rate. There's a concept known as EVA and MVA. Let's understand that. EVA is your economic value added, and it measures the true economic profit produced by a company. It is also referred to as the economic profit. When you look at market value MVA added, what is it? It is a difference between the current market value of a firm and the original capital contributed by the investors. If MVA is positive, the firm has added value. If it is negative, the firm has actually destroyed value. The amount of value added needs to be greater than the firm's investors' opportunity cost. Then we have the EBIT divided by EV divided by EBITDA, and so on and so forth. Let's have a look at that. So the first two ratios, so EV is an important component of many ratios, ratio analysis used to compare companies such as EBIT divided by EV and multiple, and also EV divided by EBITDA. EV of a business in a nutshell is nothing but market capitalization plus total debt minus all cash and cash equivalents. When we look at EV upon S ratios, so it compares the EV of a company to its annual sales. It enables investors to value a company based on its sales while taking into account both the company's equity and debt, more comprehensive than the price to sales ratio. Coming to technical analysis. So technical analysis is based on the assumption that all information which is available that can affect the performance of a stock, company fundamentals, and economic factors of the market and market sentiments. There are three essential elements in understanding price behavior. So first is history of past prices, volume of trading, and the time span in which this has happened.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.